Welcome to the Cardinal Commentary for the foreign equity portfolios. The S&P 500 returned 4.1% in the third quarter, but that just tells a fraction of the story. It hit more than 40 record highs through the first 9 months of the year. The Dow Jones wasn't far behind, with more than 30 record highs through the end of September. Perhaps more important is that the stock market rally has expanded beyond the Magnificent Seven of Apple, Microsoft, Amazon, Alphabet, Tesla, Meta, and Nvidia, which dominated American and global markets over the last 2 years. The less concentrated the market, the better for investors. We're not surprised by the many record stock market highs, as the Fed cut interest rates by 50 basis points in September. It's the first cut in 4 years. Portfolio manager Terry Wong says history has shown that a growing economy plus falling interest rates tend to be very positive for stock markets.
I think that we're in an easing rate cycle for interest rates, where we'll see many central banks across the world drop interest rates well into 2025.
With most global markets up about 25% over the past year, stocks have become more expensive. For many sectors, including financials, pipelines, and utilities, their price-to-earnings ratios have merely moved from low to normal. Technology is the exception, with some of our companies in our portfolios now trading at 25 to 30 times earnings. As part of our risk management, we have trimmed our positions in Oracle, SAP, and Broadcom. But because they are relatively inexpensive compared to their peers and have excellent growth prospects, we are continuing to hold them. But regardless of what's going on around the world, we continue to invest in companies that can weather any storm. Let's crack open an ice cold Pepsi to talk about one of those companies, PepsiCo. While PepsiCo is often compared to the Coca-Cola company, they're actually quite different. All of Coca-Cola's products are beverages, while PepsiCo derives less than half of its revenue from the likes of Pepsi, Diet Pepsi, Mountain Dew, Bubbly, Gatorade, and Rockstar. Most of its revenue, in fact, comes from the sales of Doritos, Frito-Lay, Quaker Life cereal, and pancakes and syrups from Pearl Milling, formerly Aunt Jemima. Equity analyst David Amy says PepsiCo is one of the few global companies to increase its dividend every year for more than half a century, and he expects this trend to continue.
So Pepsi has a great track record of adapting to the changing consumer tastes. So whether it be reducing sugar or eliminating sugar or expanding into energy drinks or sparkling water, they've always been at the forefront of these changes. Additionally, there's an opportunity to grow further in international markets. So they're currently building out manufacturing and distribution capabilities to take advantage of these growth opportunities.
We look for annual dividend growth of 8 to 10% with our companies. So PepsiCo is right in the sweet spot. 4 of our companies increased their dividends during the third quarter, led by T-Mobile at a whopping 35.4%, followed by Sony Group at 18.8%, and Honeywell and US Bancorp. This brings us to 21 increases for the year so far. All of those dividends have contributed to excellent returns net of fees over the last 2 decades. Here's the proof. If you invested $500,000 in this portfolio in 2002, it would be worth more than $3.2 million today, outpacing what you would have earned in the benchmark by more than $400,000. And all of this demonstrates our commitment to clients, a common sense path to long-term wealth, because it works. And that's the Cardinal Commentary for the foreign equity portfolios. Thanks for joining us.